So yesterday we talked about how the Fed isn't coming to rescue mortgage rates, but today there's some talk that Fannie Mae might be looking at another way to ease the pain, not through rate cuts, but through something called loan level price adjustments, or LLPAs. Now, before anyone gets too excited, this is not official policy. I've seen way too many videos the last couple of days stating that this was guaranteed to happen. It's under review, but if it does happen, it could quietly provide some much needed relief to borrowers. So here's what's going on. According to reporting from HousingWire, the Federal Housing Finance Agency, which oversees Fannie and Freddie. I know I hate acronyms too, but we gotta use them sometimes. They're reviewing the current structure of LLPAs, another acronym. Basically, these are the add-on fees that get applied to conventional loans based on credit score, down payment, or loan type. So think of an example like someone with a 600 credit score is going to get an adjustment to the rate or fee that's higher than somebody with an 800 credit score. Those adjustments are called loan level price adjustments, or LLPAs. Now, Barry Habib, who's both a respected industry analyst and a Fannie Mae board member, is reportedly advising on this review, and he's been very vocal about how the current LLPA system is hurting affordability. The idea is that if these pricing adjustments get recalibrated, Fannie could lower costs for credit-worthy borrowers, and that would indirectly help rates feel a little more manageable even if the Fed isn't buying mortgage bonds. Let's be clear, this isn't a done deal, and it won't replace what the Fed used to do, say back during the pandemic, when they were purchasing mortgage-backed securities, which was driving rates down to historic low levels. This would be a structural change in how Fannie and Freddie price conventional loans. It's not stimulus-style intervention, but if it happens, it might mean small but meaningful savings, maybe an 1/8 to 1/4 point in rate improvement for some borrowers, or just lower upfront costs on new loans. Here's why it matters. When most people think about rate relief, they only look in the direction of the Federal Reserve. But this move, if it goes through, would come from the secondary market. That's actually a much smarter, longer-term way to improve affordability. So for now, take this as a potential positive sign. The first sign that major housing agencies are at least acknowledging the pressure buyers are under. But until there's an official announcement, treat this as something to watch, not something to count on. When it comes to mortgage news, accuracy always beats hype, and that's why I wanted to break this one down for you properly. If you need to know what rates look like now for your specific scenario, comment or reach out and I'll work those figures up for you if you are in Arizona, Oregon, or Washington, where I happen to be licensed. Otherwise, I'll see you all on the next video. Comment or DM if you have any questions about any scenarios, just in general. I'm happy to help out.